In this video, we're going to look at the role of commercial banks in the creation of money. We start first by defining money. Money is an asset that can be used as a medium of exchange. As a medium of exchange, we mean an asset that can be used to do transactions to buy goods and services. Many times we will use the word liquidity or liquid assets to refer to money as well. The two most traditional forms of money, or two most traditional assets that we can think of, are currency or cash, banknotes, and deposits as commercial banks that can be used either by using a credit card or a debit card or a check to do purchases as well. Now, if we think about how do commercial banks interact with this definition of money, if we have a very simple and stylized balance sheet for a commercial bank, they take deposits from their clients. They have other sources of fundings, including loans from the central bank. And the way they do their business is by giving loans and buying securities. And those are both assets that will earn a certain interest rate for the bank or a certain return for the bank. Now, the commercial banks will have to keep some of their funding or some of their assets as liquid assets, which for a commercial bank, that will be an account that they have at the central bank that we call reserves. So the role of the central bank in this system is to be a bank of banks. So these reserve accounts will be sitting in the liability side of the central bank, because the central bank is like the bank of the commercial bank. The central bank at the same time will give loans to commercial banks. That will be an asset for the central bank. That will be a liability for a commercial bank. And the central bank, when they issue new currency, they will record that as a liability to them. Now let's have a couple of definitions of money given how these two balance sheets look like. The first definition is what we're going to call the money supply of an economy. This is liquidity as seen by the private sector. Now, what does the private sector see as the assets that are available to do purchases? On one hand, they have currency, banknotes that are in circulation. On the other, they have deposits as commercial banks that they can use to do purchases. The sum of these two will be equal to the money supply. Now, the central bank does not directly control one of these items, which is the deposits, but what they control is the size of their balance sheet. Now, if you look at the liability side of the central bank, the two items, one of them is the same as before, currency. The other is these accounts that the central bank controls, which are the reserves or the deposits of commercial banks at the central bank. Now, the sum of these two accounts is what we're going to call the monetary base, and this is what the central bank controls because they can control the size of their balance sheet. Now, what is the relationship between these two numbers, what we call the monetary base and what we call the money supply? Now, the monetary base, as we said earlier, is simply the balance sheet of the central bank. The money supply is the liquidity perceived by the private sector, and as such is going to be influenced by how commercial banks operate. Now, the first question is which of the two is larger, which of these two amounts is larger? If we look at the formula, they both share one asset, which is currency, and then they have an asset which is different, either reserves or deposits. Now, in the modern banking system, the banks operate under what we call a fractional reserve model, where the amount of reserves they hold is always smaller than the amount of deposits. Now, that means if we look at the formula, that the monetary base will typically be smaller than the money supply. Now, the difference between the two, or to be more precise, the ratio of the two, is what we're going to call the money multiplier, and it's going to be the liquidity that the commercial banks can generate in addition to the liquidity that the central banks introduce, and that's what we call the monetary base. Now, let's see this in action. Let's look at a commercial bank or a commercial bank system that lives under a fractional reserve system. And let's think about a very simple exercise where somehow there's an increase in currency in circulation of 10,000. So somehow the central bank introduces an additional $10,000 and puts them in circulation. So that's the beginning, that's the first step. We have $10,000 in additional liquidity. Let's see how the commercial banks can multiply this amount. Let's first think about this $10,000 being deposited at a commercial bank. And as they get deposited, this will be a liquid asset that the commercial bank will have in case any of their customers come back and wants to withdraw some of this money. So the initial position of the commercial bank would be very simple: $10,000 deposit, $10,000 reserves. But of course, this is not stable. A commercial bank does not have any interest in keeping 100% of the deposits as a liquid asset, as reserves. Let's say, just to make our example very simple, that the commercial bank is shooting to keep about 50% of their deposits as reserves. We can think this about as a reserve ratio, which is how much liquidity as a percentage you want to have relative to the deposits. Now, if that is true, what the commercial bank will do is these $10,000 that show up as a deposit, they're going to keep 5,000, that's 50%, and the rest, they're going to give it as loans to another customer. Now, so far we have still the same $10,000 in deposits, but now we have to ask the question, where does the loan go in this economy? Where do those $5,000 go? Now, very likely, they're going to go towards some purchase of goods and services. That was the purpose of the loan by the customer that took it. Now, when that happens, what is it that we're going to see? We still have the first deposit, which is $10,000. But now these $5,000 that were taken as a loan were used to buy goods and services. And that income received by the seller of those goods, let's say, is likely to be deposited at some bank. We're going to call that deposit number 2. And here comes the $5,000 that are added. But as this money is being deposited in the bank, that means that now the money has flown back to the bank, either the same or a different one. So now if I look at the banking system, we're back towards a $10,000 level of reserves, the $5,000 that were kept in the first round and the $5,000 that are added now. And we still have that pending loan that was given in the first step. Now, if we look at the ratios here between reserves and deposits, we're off because remember we said that we want reserves to be 50% of deposits, and here we are above 50%. So once again, if we follow the same 50% rule, which is just an arbitrary rule for this example, the bank is going to increase the amount of loans because the amount of deposits is in total 15,000. They want to keep half of that as reserves, which is 7,500. They already had given a loan of 5,000, but they have an extra $2,500 to give for a second loan. So in this case, once again, the commercial bank has achieved the 50% ratio. But the story does not stop here because these $2,500 that I've given as a new loan is likely to lead to new purchases of goods and services and an additional deposit by the person who sells those goods and services. Now, when does the process start? If we keep doing this until we reach what we're going to call an equilibrium, where do we end up? Well, we're going to end up in a world where deposits, the total, is going to be 20,000. The amount of reserve is going to be 10,000, which is 50% of the deposits, and the amount of outstanding loans will be 10,000. Now we've reached an equilibrium after all these rounds of loans, purchases, deposits. This is an equilibrium where banks don't want to give more loans. Now let's think about what happened. What happened to the total money supply? Now, when we started, when only the $10,000 had been introduced as cash, the money supply was $10,000 of currency, and there was no increase in deposit at that point. So we had a total of $10,000. After we've done what I'm calling the credit expansion, how much currency in circulation we have? 0, because all has come back to the commercial banks. But now the amount of deposits is equal to 20,000. That means the new money supply has increased by 20,000. Now the ratio between these two magnitudes is the multiplier. Central bank introduces $10,000, but the money supply increases by a factor which is twice as much. The ratio of the two, which in this case is 20,000 divided by 10,000 equal to 2, is what we're going to call the money multiplier in this case. The money multiplier is simply a reflection of the liquidity that the commercial banks have created by following a process of giving loans, loans that lead to purchases, purchases that lead to additional deposits, and that cycle it ends up producing twice as much money as the central bank had introduced.